The current US equity market is showing increasingly obvious signs of a massive bull-bear disconnect. My personal take, on one hand, the industry fundamentals are so strong, you want to go all in. On the other hand, the macro risks are so heavy, you want to go liquidate everything and go to cash. I am sure a lot of you feel the exact same way. Okay, I was busy yesterday and I didn't post, and a lot of you guys were pushing me to talk about the Nvidia earnings. So let's get into it today. Honestly, reading this earnings print almost made me drool. Here's the core highlights. Blackwell has officially become the primary revenue driver, with deployments scaling up across the board. Data center networking revenue absolutely exploded, up 199% year over year, nearly a 3x jump. And Jensen officially declared on a call, the era of agentic AI is here. Tokens are generating profit and AI is finally creating real value. And plus, Nvidia just dropped the Vera CPU, proposed build for agentic AI, instantly unlocking a brand new $200 billion TAM. There's another crucial detail. This time, they split data center revenue into hyperscale and ACIE, and it's basically a 50-50 split. In plain English, Nvidia's AI demand isn't just being propped up by big tech anymore. AI clouds, enterprise, industrial, and sovereign AI are all heavily contributing. Meaning, even if big tech capex peaks, Nvidia isn't going to collapse. So, from an industry perspective, the agent era is here. Compute equals revenue, compute equals profit. Every single node in the AI supply chain is a bottleneck. It feels like if we get any short-term sell the news pullback, well, you know the drill. But just as it started drilling, I have to swallow it back. Everyone says be bearish, but don't short. But man, it's hard because the macros just keep piling up one after another. Okay, let's start with market structure. US equities are sitting at historical valuation highs, driven almost entirely by the AI narrative, and incremental liquidity is already stretched thin. What's worse, retail is aggressively chasing the pump, pushing margin debt to all-time highs, while hedge funds are collectively shorting the market. Goldman Sachs data shows that as of May 18th, hedge fund short exposure on major ETFs are like SPY and QQQ hit 13% of total exposure, nearly double pre-pandemic levels and the most bearish positioning since 2021. The S&P 500 is just inches away from all-time highs, but smart money is quietly hedging for a massive downside flush. Retail think it's going to the moon in the short term, while hedge funds are betting on a crash. Talk about a massive disconnect. Okay, now let's look at the macro front. We've got three massive headlines weighing that down. First, high oil prices and inflation pressure. The US-Iran situation is flipping 800 times a day, and the surging oil is already bleeding into inflation. US Treasury Secretary Bazen publicly stated that the spike in bond yields and energy prices is directly tied to the Iran conflict, with new Fed Chair Wash stepping in. If oil stays elevated, this monetary policy runway is going to be severely compressed. However, weighing all the pressures, whether it's Iran economy crisis or US inflation and political heat, May is actually the optimal window for negotiations. We might see a macro pivot here. And second, the 10-year Treasury yield pulled back slightly from 4.687% to 4.59%. But the 30-year is still sitting at a massive 5.13%. Fed minutes show the probability of a rear hike is still hovering around 52%. Remember this critical threshold. The second the 10-year yield crosses 4.6%, Trump will lose his patience and start intervening to save the market. Last night's press action made it obvious. Even though the AI sector temporarily matched the rate pressure with a monster earnings beat, the underlying risk hasn't vanished. Right, finally, the massive IPO liquidity drain I mentioned before. SpaceX is expected to IPO in June at a $2 trillion valuation, sucking up $80 billion or more in capital. Companies like OpenAI and Anthropic have valuations heavily reliant on forward expectations. If they IPO and miss earnings, they could easily drag down the entire AI sector. Also, even more dangerous, if multiple mega cap IPOs hit market at the same time, it would trigger a liquidity squeeze, causing a stampede as capital gets cannibalized. This is the most glaring short-term bearish signal. Though some argue one of these could be the next Nvidia, but who knows? So right now, the market is simultaneously pricing in two completely contradictory narratives. In the real economy, it is pricing in high oil, weak demand, and stagflation. And in the financial markets, it's pricing in an AI productivity revolution, believing compute would solve everything. The former is driving up oil and rates. The later is pumping equity indices. How long can this massive disconnect last? Looking at cycle models and capital flow logic, my macro guess is this: the US equity top structure is accelerating. In the short term, we would like to see one final formal melt up amidst the chop. We could see the ultimate cycle top in early June, followed by a sustained correction phase that could drag on until July or September. And you know why September? And a negative stock wave of US equity contracting will bleed into emerging markets like Japan and Korea through capital repatriation and a global risk off shift. I am not giving in to FOMO and I'm not blindly bullish. Keeping a solid cash position right now is absolutely critical. Moving forward, keep your eyes on two things. First, Warsh's first public speech after taking office. The market would dissect every single word regarding the pace of QT, his inflation tolerance, and the probability of rate hikes. And second, the upcoming PCE and CPI prints. These will directly dictate the trajectory of treasury yields, which will instantly reprice tech valuations. Let's wait for the market to pick a definite direction. Right now, patience pays more than anything else. As always, this is just my personal trade analysis, not financial advice. And also, shout out to ABC Financial Group for sponsoring the content.